Hello everyone, welcome. A webinar about strategies today. Not actually something that I'm presenting quite often. People like strategies, so and I love Kathy Lien. She's one of the most successful traders in the world. Started at the age of 18 years old. So I mean, literally in Wall Street, he was recruited. He was working Wall Street from 18 years old. So yeah, very successful trader, as I said. So she created lots of strategies, and today I'm gonna present you two of them. It's our scalping strategy. I mean intraday mainly, but we're gonna see together how they can be applied in the market, not solely in the forex market, by the way, stocks, equities, and etc. So as usual. I would love to guys to let me know whether you are facing any audio or visual issue. I will, by the way, it's been recorded as usual, so don't worry about it. And before I start the disclaimer warning, just to once again introduce our new name, AgeFM. So we're getting evolving from Hot Forex into AgeFM. Nothing changed. We're the exact same people, exact same values, but the new name will allow us to help to provide a, a, a bigger range of assets for you. And as I have stated in the past, we will soonish provide to you physical stocks. So you could soonish we're gonna have available the physical stocks in which you can invest into. So that's the only reason why we have changed our name. We are the same exact people, so don't so nothing's really changing other than this logo, guys. So as I said, I would really appreciate someone to tell me whether the audio is fine. Until I see a quick yes from someone, I will go through the disclaimer warning and in order to save some time for you. Thank you, guys. Thank you. So this material is provided as a general marketing communication for informational purposes only and does not constitute an independent investment research. Nothing in this communication contains or should be considered containing an investment advice or an investment recommendation or a solicitation for the purpose of buying or selling of any financial instruments. All information provided is gathered from reputable sources, and any information containing an indication of past performance is not a guarantee or reliable indicator of future performance. Users acknowledge that any investment in leveraged products is characterized by a certain degree of uncertainty and that any investment of this nature involves a high level of risk for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. This communication must not be reproduced or further distributed without our prior written permission. Risk warning: trading leveraged products such as forex and derivatives may not be suitable for all investors as they carry a high degree of risk to your capital. Please ensure that you fully understand the risks involved, take into account your investment objectives and level of experience before trading, and if necessary, seek independent advice. You can find our full risk disclosure in the website along with a variety of legal documents that you might want to check. So feel free, everything's online. Visit our website www.hfm.com and you will find anything you need. Here's me. I will skip myself. You already know me, I guess. So I'm gonna just skip myself. Welcome, Tamilare. Welcome, Kosi. Welcome, Agorete, for the second day in a row. So today, trading the Kathy Lien strategies. Trading with the Kathy Lien. Waiting for the deal is the very first strategy, and fader is the very second. So first of all, okay. Just to a bit of an intro, okay, because the especially the very first strategy that we're gonna see, it's based is based also on it has to do with volume, and that's why I have a small intro over here. So we're gonna see together the different sessions that we have in the market. Four different, okay, many different stock exchanges, but the biggest ones are London, Tokyo, New York, Frankfurt. So on the opening of each of those stocks, or at the closing, the volatility is much higher. But let's take it step by step, okay? So uh, in general, you should know that the microstructure of forex industry, or forex exchange, general foreign exchange markets, examines the behavior of the foreign exchange instruments, either spots or forward ones, in an environment that replicates the key features of trading in the actual market. Okay, as I said, we have 4 markets. So on the flip side, traditional macro exchange rate models pay little attention to how trading in the forex market take place. Okay, so the assumption in these models is that the details of trading, like quotas, prices, how trade takes place, etc., are unimportant for the behavior of the forex prices over the months, the quarters, or longer. But for microstructure models, I know that I sound a bit weird. I'm saying very complicated words, etc., but you will understand where I'm trying to take you. So as I was saying, on the flip side, microstructure models, okay, um, they examine every single information. They examine how information relevant to the trading decisions of the traders become embedded in the price of the asset, in the price of a forex instrument, via this trading process that we are having. So based on this perspective, okay, trading is not an ancillary market activity that can be ignored when we consider how the prices of forex instruments behave. So do you understand what I'm saying? Um, Trading as such is not an ancillary market activity. Trading is an integral part of the process through which the price of forex instruments are determined and evolve through time. Okay, so that's why instruments in the forex industry are dependable from liquidity, timing, the understanding of the market participants in regards to the macroeconomic factors and geopolitical differences, but also uh, in which time zone they correspond to. So that's why some assets have their best and worst trading range at the corresponding time zone. As you can see over here, we have stock. That's for the main actually stock exchanges are 4, and each one of those has a different opening price, different trading hours. Okay, the most volatile of all tends to be the New York one, which is okay. This is the local time, by the way. This is a GMT time. So New York, New York will open. So this is GMT, will open in 2 hours from now. This tends to be the most volatile session. Not that the rest of the sessions are not volatile, but each asset that we are trading has his own. For example, if we consider Aussie dollar tends to be more volatile during um, the Tokyo session. Okay, so each of our assets have their own the volatility that they get is different per stock exchange. Okay, because they depend from different things. They depend from different geopolitical difference, from different macroeconomic factors, different liquidity, and etc. So that's just a small intro, okay? If there is anything that you don't understand, interrupt me and let me know, okay? Sorry. So, okay. Over here, I think this is not the case anymore, but uh, it has been observed that London also is one of the more is the session in which we've seen uh, significant movements as well. So most movements, according to Kathy Lien. I'm not sure whether this is still the case, but it is what it is. By the way, how volatile each asset can be is something that you can find on your auto chartist tool. So during the summer, more precisely, it has been observed, that if you have noticed over here, during summer, Tokyo session and London overlap. So they are there is like a gap in which they are both open. So there's an overlap. Okay, during summer and winter, so during the whole year, the other two sessions that they overlap is London and New York. So this doesn't change over the year. That might be one of the reasons that London tends to be more volatile than New York, because it captures also the New York Open. So this is just for your own information. Okay, I have put some currencies on just to see, for example, that pound yen tends to move the most during the London Open, and this is how much it might move on average. So it might peak as big as 150 pips sometimes. While while Australian dollar, sorry, what I'm saying, while Asia session, okay, Asia session, which take place between 12 GMT to 6 GMT, okay, it tends to be the quiet session out of the four, okay. So you see that this blue line, you can see that the comparison with the other two sessions is the one that is moving the least. Okay, so let's stick a bit over here. Let's stay a bit over here. So actually, let's move on. And just to remind you guys that now let's shift to the market and the assets that we can see in the market. We have currency better, we have equities, we have commodities, energies, etc. We have many products, but regardless of how many products we have over there, the dominant currency of the whole world, so the currency that has been used nearly for every single exchange that takes place, is dollar. So the dollar remains the world's dominant vehicle currency. Okay, so these are some old graphs. So it's 2016 with the blue and 2019 with like pink. Okay, here are the currencies, here are the currency pair. Okay, and you can see that 88% of the trades for a single month, it was April. So the sample of this research was for April. Okay, you can see that 88% of all trades in April, it was the dollar was used in the 88% of all the trades that took place in April in 2019. The same stands for 2016. Again, dollar is a dominant vehicle currency. So it's nothing that it hasn't changed, even it would never change, or it's unlikely to change anytime soon, if you ask me. Um, so as you can see over here, the relative ranking of the next 7 most liquid currencies didn't really change from 2016. Okay, so we have this as a second one in place. We have um, pound. Then we have. I'm a bit lost over here. Just a second. So we have dollar. Sorry, the second one is euro. Yeah, then we have the global share of EME currencies, which is at 24.5%. We have pound as well. So you can see that over the years, this hasn't changed. By the way, over here with the EME, emerging markets, this is it, the emerging market currencies appreciated a bit, but in general, okay, that's the emerging currencies this includes a lot of currencies like rand, Turkish lira, ruble. That's why it's like the 13th place, if I'm not mistaken. But it combines a lot of currencies. We cannot not really say that uh, uh, in the ranking place should be considered, but nonetheless, it's just a research. Now, euro is the second most traded currency of the world. Okay, so is the European Union is a common currency and is the second one with 32% in global trading. Okay, so in contrast, the yen is very low compared to pound, dollar, euro, and other important currencies such as also in Canada, and is the only one, as you can see this chart over here, is the only one that we have seen a turnover. It has stagnated. This is because over the years, the yen's share in global turnover dropped. Okay, so here's its dominant place has changed. So this fall in yen it was mostly due to a contraction in the important dollar-yen cross. So there is low volatility. If there is low volatility, if this is a year with low volatility, yen tends to lose its some of its global turnover. Okay, against the major currencies. But okay, these are a lot in detail. I think I'm gonna leave it as it is. I will stop here in regards to this slide because it's not so important for today's strategies. It's just a small intro. Over here, just for your own information, I have put on a table with like countries, years, and actually the amount, the net gross, as you can see over here, is this is a table taken from Bank of International Settlements. Okay, So in April 2019, sales desks in 5 locations, so UK, US, Singapore, Hong Kong, and Japan, intermediated 79% of all foreign exchange trading. Oh, I forgot to upload the handout. Give me a second, Shaik, just to get rid of the intro in order to go straight to the strategy. Okay. So as I was saying, this is what this table is about. It presented 79 there is a ranking of these trading hubs that remain unchanged from 2016, and the share per country, the relative share in global turnover per country and per year. So the share of trading, taking place in US declined to 17% in 2019 from 20% in 2016. You can see, but these are all data. Who cares? Why it's important to be aware of this data is because you can figure out how important each of these, what's the global turnover for each of these currencies. So now the picture for dollar obviously change, and the trading and its share in global turnover is much higher than the 20% that it has been for nearly more than 20 years. Okay, so that's just a small intro, and we can move on. Okay, let me upload right now the handout. Give me a second. Come on, come on, come on. Wasn't saved. Bizarre. Let me try again. No, don't worry. There's nothing to be worried about. Don't worry. Or it's just my PC getting silly. I think it will be fine right now. Have a look. Okay, still okay. Yeah, have a look now. Let me know if you can see it. So let's move on. And why I have done all this big lengthy intro? Just because the very first uh, strategy that we're gonna cover is based, it has been created based on this information, the information that I just told you, the dominance of each currencies worldwide, the average movement that they are moving per session, which session is more volatile for each asset. So Kathy Lien, managed to create this strategy based on this. Okay, based on this information. So she created a strategy that it can be applied on the opening of each session, depending obviously which asset you are trading. So the lack in general of volume data in the Forex market is something that is forcing a lot of day traders, more precisely, to develop strategies, right? Different strategy. Each one of you obviously has his own strategy, amended based on the asset he's trading, on the time frame that he's trading, and etc. So in general, if there is a lack of volume, strategies need to readjust their strategy or find out a different strategy that rely less on the demand of on the level of demand and more on the microstructure of the market. That's why I explained earlier where the microstructure, what's the microstructure, where it is based on. Yes, Shai. Yes, her book is called Day Trading and Swing Trading. Okay, it's a brilliant book, full of strategies. That's why I'm presenting it this webinar. I'm not sure how you can get it. Uh, I borrow mine from Stuart, but you might try online. It is called Day Trading and Swing Trading, Kathy Lien. So yeah, it's a brilliant book. So yeah, as I was saying, so one of the most common characteristics that day traders try to exploit in the markets, 24-hour around the clock nature, is the waiting for the real deal strategy. So have in mind that although the market is open from trading throughout the course of the day, the extent of market activity during each trading session varies, right? So, for example, traditionally, trading tends to be, as we said already, quiet or quiet tests, quiet tests during the Asia market. Okay, uh, the volatility is less, the volume is less, we don't have a lot of news coming out in the Asia session. We don't have a lot of speakers like central bankers, etc. I will type the name of the book just to make this for you easier. Day trading and swing trading, the currency market, by Kathy Lien. Yeah, it is central. So, yeah, as I said, the Asia session tends to be the quietest due to all these reasons that I just mentioned. So this means that currencies such as euro, dollar, pound, and more precisely currency pairs such as pound dollar, euro dollar, and etc., tend to trade the least during the Asia session. They tend to either consolidate, having a very tight range during uh, these hours during the Asia session. And that has been proven. I mean, there is a study, the study that I showed earlier from the Bank of International Settlement. Um, um, and it has been published in 2004, if I'm not mistaken, but there is definitely an updated one. So it has been proven that the United Kingdom is the most active trading center, and it captures 31% of total volume. And because during the United Kingdom session, that we have also Germany on, France on, Switzerland on, so all the European trading and the Frankfurt Stock Exchange, Paris Stock Exchange, all are open during the London Open as well. So, and adding to that, adding to the United Kingdom, adding this, the rest of the European trade, the rest of the European countries, such as Germany, France, and etc., the European trading at 8 GMT is it can reach up to 42% of the total forex trading. That's why it's the most active trading center of the world. The United States, on the flip side, on the other hand, is the second one too. Is the second after the United Kingdom, with just 20% of total turnover. So here, this proves what I'm just saying. This is a caption from AutoChartist per hour, and you can see that during the London Open, the average that the pound, the cable can move is around 35 pips. Okay, it also moves. So we have over here, so that's from 0.20, actually here, 0.20 up to 30 something. So this is one of the most volatile time of the day for cable, and then the second most volatile time of the day is, I think, not that one, but that one is at 3 o'clock. This is Cyprus time, which we have a lot of volatility as well. So you can find this kind of information, by the way, if you have auto chart this. Okay, it's in on the volatility analysis. But let's move on. And let's go straight to the strategy and the steps. These are the steps for the strategy, because Kathy Lien created this strategy based on this, the thing that we have just said, how the percentage of total forex trading per session, what's the based on the share of each pair on the global turnover, and the volatility in general. Okay, so that's why it's critical to understand, uh, to actually figure out and to have a note which currencies are more volatile per session. Okay, not in order to avoid trading something that for a particular session is just ranging. Okay, so one more thing before we see the steps is that, remember that I told you about overlapping. So, for example, pound trades most actively against dollar during the European and London trading hours. So there is also active trading during the US and European overlap. But besides these time frames, the pair, the cable, tends to trade relatively lighter, okay, because the majority of cable trading is done through UK and European market makers. So that provides a great opportunity for the day traders, if you are one of them, to capture the initial directional intraday real move that generally occurs within the very first few hours of trading in the London session. And I will show you exactly right now how this strategy exploits this common perception that UK traders are notorious stop hunters. Oops. Okay, so um, since UK and European dealers are primary market makers for cable, they have tremendous insights, right? Into the extent of actual supply and demand of the pair. So the trading strategy of waiting for the real deal first sets up when interbank dealing desks survey their books at the onset of trading and use their client data to trigger close stops on both sides of the market to gain this pip differential. So once these stops are taken out and the books are clear, the real directional move in cable will begin to occur, at which point we look for the rules of the strategy to be met before entering into any long or short position. So this strategy works best following the US Open or after a major economic release. So what I mean, this strategy, the particular strategy, works in the European session, in the US session, sorry, after we have investigated what happened to the cable in the European and London session. Okay, so let's take it step by step. Because with this strategy, we are looking to wait for the noise in the market to settle down and to trade the actual market direction. So we wait for the European session to calm down, okay, for the volatility in general to calm down, and to trade afterwards the real market price action afterwards. So, for example, cable, as we said, the early European trading in cable begins at around 7 o'clock GMT, right? So we have to look for the pair, okay, that time, okay. So we need to look for the pair to make, actually, let me just, okay, I think it's better for you to show you a graph. This is a capture from Kathy Lien's book. So what do we have to do? Firstly, on the European Open, we need to check where pound is. So we're gonna have a line. You need to identify to put a line on the Frankfurt Open and another line like this one on the London Open. Okay, to have two lines in order to separate when Frankfurt Open and when London Open, and to identify the range low between this period. Okay, look for your pair, either that's the euro dollar, either that is a cable, is the pound dollar, etc. Put the lines when the Frankfurt Open, when the London Open, and put a note, put a line, where is the new range low? Okay. So look, actually it's not any new range low. The range low should be at least 25 pips above the opening price seen um, um, seen after the Frankfurt um, between the Frankfurt and London Open. So we have the Frankfurt, we have the London Open. So we need to measure. We need to measure the range. The range is defined, guys, as the price action between the Frankfurt and London Open. They have an hour gap. Okay. Okay. So we have identified the range, right, between the low range between Frankfurt Open. Okay. So yeah, let's go through that first, Diara Correde, and if we have time, we're gonna see sorry, live ones as well. So in the case of a long trade, okay, actually in the case of a long trade, do I have okay, I have a short, okay, let's keep over here. Okay, the second thing that you need to check is whether the pair reverse after the London Open and penetrates the high. Then the next thing that you have to do, if this happens, if the pair penetrates after the London Open and reverse and penetrates the high, then you can place a long position, an entry order to buy by 10 pips above the high of the range, and a protective stop loss no more than 25 pips away from the entry. While if the position moves lower by double the amount that you risk, you can cover half and trail a stop on the remaining position, or move stop on rest to break even and target 3 times the risk, or even and 105 pips on the remainder. Okay, so let's take it step by step. Okay, let's take by step. I don't have an example of a short position, a long position, but I will the same thing, the same mentality, the same steps lie on the short position as well. So let's see over here. This is pound, as I said. Okay, let's see an example. So we see cable. We put a node on our Frankfurt Open, we have put a node on the London Open, and we can see that cable breaks up on the London Open. Is that true? You see, on the London Open, it push higher. Okay, here it is. Okay, that was on the European Open. Afterwards, it penetrated lower, so it reversed quickly lower, which is the second requirement that is necessary. But afterwards, it bounced again, right? It bounced and it extended as high as 189.13, approximately 2 hours into trading. Then the currency pair over here started turning lower ahead of the US market open, and over here, okay, is when we can position for the trade by putting an entry order to short 10 pips below the Frankfurt Open to the London Open range. So the range was between 188.04 up to 1 so the range low was at not 1.8804. Okay, so 10 pips below it, right? 10 pips below it means 187.94. Is that right? So we can place a position, we can put an entry order to short 10 pips below the Frankfurt Open to the London Open. Our stop then can be placed 20 pips higher, so at 188.14, while our taking profit entry is placed at 187.54. So this is double of what we are risking, right? If we have placed our entry at 87.94, right? 87.94, the stop loss 20 pips above it, then the target will be 40 pips below it. So at 187.54, which is double of what we have risk. So once the take profit order on the first lot is fulfilled, we move our stop loss lower. And the second lot eventually gets stopped out, and we end up with around 40 pips on the first position and 55 pips on the second position, because the asset bridge as low as 187 area. I know that's not the ideal example, so I have another one, so don't worry about it, okay? Here it is. Okay, let's do it again. It's a bit tricky initially, but afterwards you will find it easy busy, okay? So again, let's take it one by one. Cable has opened. Cable is trading. Frankfurt Open is done. So we have put a note on the Frankfurt Open. After a few sessions, London also open after an hour. So we put a line on the London Open, right? It doesn't matter whether your chart is a 15 minutes chart, it's a 1 hour chart, or a 30 minutes chart. As long as initially, so this is for a 15 minutes chart, by the way, okay? Because it allows me to put precisely my line on the open price of Frankfurt and on the open price of London, okay? So we have put our lines on, okay? And we see that cable over here. It opens at a similar level as Frankfurt open, but as soon as London opened, it bounced higher. Okay, it bounced higher, uh, breaching this high over here, the 128.94. Quickly return, right, and bounce again, finding a resistance over here. Okay, that doesn't mean anything. Okay, that doesn't mean anything because for the time being, it didn't came down to the range low. What I mean to the range low, remember, we have put the lines between Frankfurt Open and London Open. And we also need to put what is the lowest level of within this range. The lowest level within this range is the 128.69. So I have put a vertical line on. And I'm waiting, patiently waiting. I saw that it went up, then it turned quickly down, consolidated a bit, then another high, and reverted from this high. So I put a line on the range high. Okay, so far, so ignore the rest. Okay, focus over here. So initially, I have put my lines. Perfect. I have put a note that this is the range of the low, and I'm waiting to see what will happen with cable, whether I'm gonna give me a range high. It gave me this as the very first initial range high, but afterwards it peaked higher. So that was my my final high range, and I put a note over here, and I'm waiting to see what will happen. It will extend further higher, so in order for me to put another range high, or it will revert. So what happened is that it reverted and it retested over here the range low that I spotted in the London Open. So now it's a good so now the monitoring part starts because because the asset turned down and is retesting the range low. Remember that the second requirement that the waiting for the deal, the waiting for the deal uh, uh, strategy has is that the pair, if the pair reverse and penetrates the low, then we can place a position. And this is what happened here. It reverse and is retesting the low. So what we can do is add a pending position and say that if the asset breaks the range low, okay, then I will go short, but the entry price will be 10 pips below that range low. So if you're gonna apply something like that, you will set a pending order stating that if the price moves 10 pips below my range low, so in this case is if it hits the 128.60 level, then I will enter short with with target 20 pips the minimum, 35 mix the maximum. It's up to you, but the strategy says that it shouldn't be above 35. Usually it's around 20 to 25 pips, but it depends on how volatile the asset is and where also is your latest high. So over here, even though Kathy Lien says around 20 pips, I used 25 pips because it was also coinciding with my latest up fractal over here. So I put 25 pips, my stop loss 25 pips higher, okay? And now my target should be double of the amount that I'm risking, right? Double of the amount that I'm risking. So I set my target 50 pips away. Twice the 25 equals with 50. So I put my very first target at 128.10. Are you okay so far, guys, with this example? You can either place a fixed stop or a trailing stop 20 to 25 pips away. The stop, how far away the stop will be, is not something fixed. According to Kathy Lien, should be it should be 20 pips away. But you can see if you have identified that the 25 pips, for example, coincides also with this latest high. So it's a more, it could be a better stop loss, a better resistance area. Place that, but no more than 35 pips. Okay, you shouldn't place it too far away. Okay, otherwise you will suffer a lot of losses. But you shouldn't put it very tight either. Okay, so what you should, in order to identify a nice stop loss, other than that, identify the latest highs, the latest low, or support and resistance levels, you can go and get advice from auto chartists how volatile, what's the average movement per asset for a particular time. So for example, if the entry was taken around 6 o'clock, for example, okay, 6 o'clock, then you can go to a chart and see how volatile cable is at 6 o'clock. So let me see you here. So it tends to move around 15 to 30 pips the maximum. Okay, so I put 25. That's fair enough. That's okay. But on average, as you can see from auto chart, is around 6 o'clock. On average, the asset tends to move 25 pips. So the fact that I place my stop loss 25 pips away is reasonable enough. Okay, I got advice from auto chart. This is also my latest app. Fractal also coincides with the instruction from Kathy Lien, so I am good to go. Okay, that's why I don't know how many of you are using auto chartist, but even if I don't use it, maybe sometimes I don't need auto chartist to tell me what to do. I do my own analysis and I decide what I will do next. But the volatility analysis that it is offering is very helpful, very helpful. I mean, it gives me confirmation that my decision was correct. My decision to add the stop loss 25 pips away because I took my position at 6 o'clock in the afternoon, and on average the cable tends to move around 25 pips at 6 o'clock. It gives me further confirmation of my decision. So as you can see, it extended further down. It didn't breach my target. It rebounded. It retested the entry area, but even though it retested the entry area, my stop loss is far away, so I managed to remain in the market. I'm still in the market until this sharp drop came and kicked my target, and I have benefited 50 pips. So my very first target was hit. Remember that according to Kathy Lien, if your first position, if your first position, if your first target is being hit, you can close a part of it. You can close half of this position, and you can cover half, and you can trail a stop on the remaining of the position. So you can, over here, like here, sorry, like over here, I am good to close the 50% of my position, okay, and to add a second target, okay, 55 pips away. So it's 3 times the risk, around 3 times the risk. You can actually, you have choices to do. You can either, where is it? Sorry, you can either you can either add your position, add your second target 105 pips away from your initial entry, or to set your target, your second target 3 times the risk. So in this case, the next target will be either 55 pips away in order my first and second target to have in total 105 pips, or it could be 3 times the risk, which is 25 multiplied by 3, 60, 75 pips away. Okay, so you can either, guys, I remind you, you can either stop over here and close the full of your position, but or you can close the half of it, set a second target for the remaining of the position, either by using trailing stop, either by drag and dropping your stop loss lower, okay, from the initial level, I mean. So in this case, the second target wasn't hit, but it doesn't matter because I have already locked my very first 50 pips from the very first position. So I'm not in loss. I'm still on profit. Even though things didn't turn out good for the remaining of my position, but I managed to lock profits anyway by partially closing my position. Now, that's one example. So the same things stand for a long position as well. It's just I didn't manage to find a long position. If we have time later, I'm gonna show you a long position as well. Let's go to the second strategy, okay? Okay, the second strategy is called fader. It's called fader. So, okay, things are easier with fader. It's not as theoretical as I mean, to understand the sessions and etc. It's not as theoretical as the waiting the deal. So the fader. Very often, traders find themselves facing with a potential breakout scenario. Position for it and then only end up seeing the trade failing miserably and have price revert back to the range trading, right? Isn't it? I'm sure that you have faced it in the past. I mean, you open a position and eventually your position broke even, but instead of closing your position since it turns against you, you um you only end up you kept the position, so you are on loss and you keep the position on the perspective that they will turn back on your favor, but instead is it has reverted back to a range trading or something. So this is something common. But in fact, even if prices break even at a particular level, okay, and they range or something, or if they break out above a particular level, it doesn't mean, it's not a guarantee that a continuation move. So okay, let me say it in a in a simpler way. Okay, very often we can see in the markets breakout scenarios. Okay, breakout scenarios. But have in mind, right? Have in mind that an asset, if an asset managed to return to break out, as we said, at a particular level, okay, if it had a correction, if anything, if it was it had a correction and then turned back to its initial level, that doesn't mean that the trend will continue again. It doesn't guarantee a continuation of the move. Let's assume that it was in an uptrend and we have seen significant pullback and then rebound again. And so let's, for example, let's do that. So that's oil, for example. It was in an uptrend. Okay, it turned down. It rebounded again. If it gets back to the previous high, it doesn't mean that the trend will continue. There is nothing guarantee about it. There is no guarantee that the initial trend will continue. If this level is very significant, we tend to see very frequently the dealers, the interbank dealers or other traders trying to push prices beyond this level in order to run stops. So breakout levels are very significant levels. And for this very reason, there is no hard and fast rule as to how much force is needed to carry prices beyond levels into a sustainable trend. Okay. So trading breakouts at key levels such as this one can involve a lot of risk. And as a result, a false breakout scenario appears more frequently than actual breakout scenarios. So sometimes prices will tend sometimes we see prices like retest resistance levels again and again and again. Sometimes we see retesting the same level more than 3, 4, 5 times before they manage to break it. Let me see if I have an example. Do I have an example? Not in oil, apparently. I think I have an example in gold, though. So let's see. Either in gold, dollar cut. So okay, dollar cut, why not? You see, it retested this area, 128.50, once, twice, 3 times today and didn't manage to break it. It might eventually break it, who knows? But what I'm trying to say is that the trading breakouts at such as key resistance or support levels, it has risk. And we might end up with a false breakout scenario because sometimes the price tests again and again the resistance or its support levels more than once. Okay, so this has fostered the development of a large contingent of contra-trend traders who look only to fade breakouts in the currency market. So fading every breakout can also result in some significant losses because once a real breakout occurs, the trend is generally strong and long-lasting. So what this boils down to is that traders need a methodology for screening out consolidation pattern for trades that they have a higher potential of resulting in a false breakout. That's why Kathy Lien, in order to avoid this false breakout, in order to identify the trades that they have the higher potential of a breakout, she created this strategy. So the fader strategy is a variation of the waiting for the real deal strategy. So it uses the daily charts. So be careful. Over here we have a particular time frame. We have daily charts. So it uses the daily charts in order to identify the range bound environment, and then it's going down to the hourly chart in order to find its entry level. Are you following? So in this strategy, we need daily chart and hourly chart. So in the hourly chart, we're going to place our entry. In the daily chart, we need to identify the range bound. So the very first rule, let's check the long scenario first. The very first rule is to put on your currency pair, on the asset that you are about to trade, an ADX indicator, a 14-period ADX indicator, and check whether the ADX is less than 35. Remember, we are in a daily so here I have a daily chart. So the very first thing that you need to do is place an ADX, and as soon as you see if your ADX is less than 35, okay, this is Aussie dollar in a daily chart. I have my ADX and I have seen that is less than 35, actually is even less than 20. So you will start monitoring the asset as soon as you see it turning below 35. Okay, and it's trending. So in this case, it's in a downtrend. It's is the currency pair is in a downtrend. My ADX has started detecting and it moved below 35. So at that point is where I start monitoring the trend, because this indicates that the trend is weakening further. So what I need to do is wait for the market to break below. I need to keep monitoring the ADX, but I need to also put some lines on. I need to put a line on. I need to identify the low area, the latest lows. So here I have a repeatable lows, okay, at 0.7318. I need to put the resistance areas on the latest highs, right? Because these are might be useful for my entry, but for the moment you need to just start monitoring. As soon as you see, so I have seen, remember I started monitoring, but I have put the lows, the highs, but my asset is consolidating. It declined, the ADX declined below 35, and then eventually it crossed below 20, and it keep detecting down to 15 level. But however, afterwards, it started appreciated again. Okay, started appreciated. And what I need to wait now is to see whether the market will break below the previous day's low by at least 15 pips. So when did I saw that? I saw that over here. Over here. The asset move above my previous day's high by more than 15 pips. Okay, you see that? There is a tiny tail. Do I have a zoom in? Let me check. Yeah, this is our chart, but yeah, let's remain on the daily chart. So I was monitoring ADX and I have seen by measuring every day the prices, I have seen that on that day it spiked higher and it moved 15 pips above the previous day's highs. So, okay, it's easier to identify this kind of this move 15 pips above or below the previous day. So in this case, we have a move 15 pips above the previous day's high. So this is triggering a short position. Okay, so if you see the next day the asset to break to move 15 pips above the previous day's high, this is a short position. If you see your asset moving 15 pips below the previous day's lows, then that's a long position. So in this case, we have a short position, because you need to go down to your 1 hour chart, right? So it topped over here. My ADX is above, in this case, is above 35, right? Because so it's above 35. And this is the top that I had the previous day, and the new open. Can you see this is a new day? It opened, it jumped as far away as it could, and I have measured that this is 16 pips above the previous day's high. So my very first requirement, my very second requirement actually has been satisfied. The very first requirement was the ADX. Okay. Okay. So now, since ADX is satisfied and the 15 pips have been satisfied, at least 15 pips, now I can place an entry order, a short order in this case, 15 pips below the previous day's lows. So the previous day's lows is over here. So I can place my entry 15 pips below it. Okay, the maximum 50 pips below it. Okay. So once filled, place the initial protective stop no more than 30 pips away from the entry, I mean, okay? No more than 30 pips above your entry. And you can take profit 60 pips in your favor. So let's take it step by step. Let's go back again to the rules. So if you have a short position, okay, you need to place in your daily chart ADX 14 period, okay? You need to, firstly, in your daily chart, identify a range, okay? Identify a range. So put, if your asset is consolidating, place a line on the low area and place another line on the high area, okay? That's it, one thing. And check whether the ADX is detecting or appreciating. Okay, if it's detecting, then that's an alert that the trend might change. The trend is weakening. Okay, so if the trend it turns below 35 or even below 20, that means that the trend, if the DX trend tends below 35 or even 20, that means that the trend is weakening further. So you have done your observation in the daily chart, so you need to go to the hourly chart now and monitoring. If you've seen on the open of, if you observed in the morning how your asset open, okay, and see what's the latest high that you have get. So on the 9th of August, I was monitoring my Aussie and I saw that it peaked at 0.7454. Okay, so if you have seen a peak, measure it and compare it with the previous day's peak. Is it more than 15 pips difference? If it is, then you can apply your fader strategy. So that means that you need to enter the market short, okay, as soon as your asset, here it is the very third step, as soon as your asset turns 15 pips below the previous day's low, okay? So here it is. The range low over here, it was at 0.7382. So you need to measure 15 pips. Over here, I think I made a mistake, but nevertheless, you should place your, did I? Let me check something. So the previous day's low was at 0.70, it was the green line, was, yeah, 0.7382 was the previous range low. So I need to open a short position 15 pips below this level. So 15 pips below these levels, that should be 0.73 68. I did a mistake over here. I put the entry earlier, just 5 pips below my low. But yeah, okay, my bad. the max, however, according to Kathy Lien, you should put your place 15 pips below that level. Okay, below the only reason I think that why I put my entry over here was this, the fact that it tested this level twice and finally break it with a full body bearish candle. That's the only reason. But guys, it's better to keep your to stick on your on the guidelines. So 15 pips away, 15 pips below the range low should be your entry, your short entry, and your stop loss should be no more than 20 pips above the entry. No more than 20 pips above the entry. Now, the take profit should be double. Either you can place multiple targets, so the very first target to be 20 pips, or you can put your very first target twice what you are risking, so 40 pips away, and having a third target as well, 3 times what you are risking, so at 60 pips away, and so forth and so forth and so that's solely up to you, as long as you are locking some profits and you make sure that your stop loss is no more than 20 pips above and your target is either equal to 20 pips or double of the 20 pips that you are risking. Okay, target has been reached. So if the target, your very first target has been reached, then you can place a trading in stock for the remaining of the position until your second or even third target, if you have placed a third target, is being hit as well. That was a short example. Here is a long example. So you see, we put a line on the previous day's low. We put a line on the previous day's high. Okay, so we have a range. And we are waiting to see whether the next day the asset will move either 15 pips above the previous high or 15 pips below the previous high. Okay, so in the new day, the asset over here, oh, sorry, I'm running out of steam. The asset over here moved 15 pips away below, 15 pips below the previous day's low. Okay, so that's actually greater than 15 pips, but this is not a great move anyway, so that's fine. Okay, so we have this 15 pips, so that is triggering a long position. But why this is triggering a long position? Because not only because it moved 15 pips below my previous low, sorry, but because also ADX, I noticed yesterday that ADX is drifting and is less than 35. Okay, you have two requirements over here, either be less than 35 or even less than 20. Okay, because that implies that the trend is changing. Okay, so that means that the trend is changing. So this is changing and is weakening further. So ADX checked, 15 points below the range low checked, so I could enter long. And as we've said, around 15, no more than 15 pips. The entry should be no more than 15 pips above the previous day's highs, because this is a long position. So I'm waiting my asset to turn back to retest the previous day's highs, and as soon as I see it breaking, I could enter long 15 pips above the previous high, with stop loss first of all, with stop loss 20 pips lower. Okay, so my stop loss is here, 20 pips below my entry, and target double of what I'm risking, so 40 pips higher. And if I want, I can place a second target as well, 3 times higher. So that would be at 60 pips away from the entry level, and so on and so forth. So that was pretty much it, guys. Yeah, so that's pretty much it. That's the logic behind the fader strategy. So if you don't have any questions in regards to the strategy, I'm done with it. Just make sure that if you are about to apply any of these strategies, if you're ready to enter based on any of this strategy, make sure that there are no significant economic data schedule the time that you're going to enter the market. Okay, because it might kick your stop loss and then gets back to your direction due to the to sharp unexpected volatility and movement. Make sure that, especially the false breakout strategy, the fader strategy, it works best when there are no significant economic data releases. Okay. And also, these two strategies, they tend to work better for currency pairs because we have discussed why, because of the which currency is the dominant of the world, which currency is more volatile per session, etc. So it has to do with the volatility, the timing, the liquidity of the currency pair. Okay. Okay, it is not as confusing as you think, Akorede, but it is like to be extra careful. Okay, the inside the very first strategy is a bit complicated. Try first, or actually try to read, not to apply. Try to read firstly the fader. The fader is more straightforward. Tried it in a demo account, okay? Try the faders first. If you tried, I'm sure that it will be clearer on your head. Okay, the very first one, it was a bit complicated, but this one is not so complicated. Okay, neither is this first one, but it requires more steps than the fader. What you have to have in mind in regards to the waiting for the deal one is to put all the necessary lines that you have, that you have to put the line on the Frankfurt Open, to put the line on the London Open, to identify the range low, and as soon as the range low and the range high, so the range low the range low will be identified as the low price between the Frankfurt and the London Open. This is the range low. Then, then patiently wait until you see a high, the latest high, and put a line at the high, and then wait. If the asset reverse and retest the range low that you have identified between that hour gap between Frankfurt and London, then you can enter short with the steps that we said. Your target to be, your stop loss firstly to be 10 pips above your entry. Your entry will be 10 pips below the range low, and stop loss twice or 3 times the amount risk, and so on and so forth. But your targets in total, if you're going to have more than two, shouldn't be more than 105 pips away. Now, in regards to a short position, the same things stand. So you still need to put lines on the Frankfurt and London Open to identify the range low, the low level between the Frankfurt and London Open, and then wait to see whether the asset will break. Okay, I didn't have a long position example, but it's the vice versa scenario. If do I have? No, I don't have a long example over here. But if your asset, so you have put the range low, you have put the range high. If your asset, for the long position I'm referring, if your asset breaks the high territory, breaks the high range, by more than 10 pips, so if it moves 10 pips higher from the latest high, then you can open a long position again with targets at no more than 25 pips away. Sorry, the stop loss no more than 25 pips away from the entry. The target to be double of what you are risking, so that should be 50 pips. Okay. And if you want to have multiple targets, then make sure that you're closing the half of your position at 50 pips and the rest of your position using a trailing stop loss or having a target no more than 55 pips away from the first target. So in total, your target should be 105 pips away from the entry level. So it needs some time. It needs time to understand the steps. It needs time to test it in a demo account in order to get familiar with it and to see also for which of your currency pairs works the best. It doesn't mean that it works for every single asset. For example, this kind of strategy, okay, it will work for Aussie, Australian dollar, okay. It might work for Australian dollar, but it might not work for Australian yen. Okay, so that's why I want you to practice, to test it in a demo account based on the currencies that you like to trade in general. So Aussie for fader, it was just fine for me. You might have an asset that fader cannot be used, but instead you can use the waiting for the deal. So test, test, test. No, Richard, it cannot be applied only in cable. My cable was just my example, but they in general they work very, very good for all the currency pairs. Okay, oops. But you need to make sure that you applied, you're taking an entry away from any major economic data releases. Okay. If we are done, I will call it a date if you don't have any further questions. Okay, wait a bit. 10, 9, 8, 7, 6. Oh, can this strategy be used only during European session? No, they can be used in Asian session. They can be used in US session. Depends on your currency pair. Depends. For example, remember, both of them have something common. The common thing is that my asset is ranging. Okay. For example, this dollar cut over here. Okay, this is the dollar cut, and I can clearly see in this 1 hour chart that is ranging, right? Is ranging. So the US Open is just an hour away, right? It's just an hour away. So I might consider trying the fader deal, the fader strategy. But I need to make sure that I need to apply my ADX to see how the ADX is. Okay, let's see. I have already on, sorry. So this is my card. So I need to get rid of some indicators because it is getting so complicated. Okay, okay. It's ranging. So is ranging, as I can see. I need to place on the previous day's highs and the previous day's lows. Perfect. I have put them on. And remember that I need ADX as well. Come on, where's my ADX? ADX. ADX 14. Okay, perfect. I will go to the daily chart and see where the ADX, come on. Sorry, where the ADX is placed. So my ADX right now, so we put a line at 20. Here is a 20. Here is the 35. So my ADX are below 35, and actually my ADX is currently the solid line is just a breath away from the 20. So that's the very first requirement has been met. My ADX is below 35 and sloping lower, and it's even retesting the 20 level. So that's fine in the daily chart. I'll go to the hourly chart. I have already put the previous day's highs and the previous day's lows. So I'm good. So now, if my asset, remember this is the fader still, if my asset today, if my asset breaks either the previous day's low or the previous day's high by 15 pips the minimum, then I can enter the market. So if, for example, it comes down and it breaks the previous day's highs by more than 15 pips, so that will means if it reach the somewhere here 127.75, so if it goes down to 127.75, so 15 pips below the previous lows, then this can trigger me a, this can this can trigger me a long position. Okay, a long position. So let me get you back to the steps again to see the steps. Here we are. If it breaks below the previous day low by at least 15 pips, having in mind that my ADX is either below 35 and or either below 20, then I could enter the market long if with an entry order 15 pips above the previous day's high. So let's get back to so if it breaks the day's low down by 15 pips, then I can place a pending order, a long pending order, 15 pips above, sorry, 15 is, 15 pips above the previous day's highs. So that would be somewhere here, 128.70, somewhere here. So this could be my long entry, okay, because it will rebound and come back. Long entry with stop loss 20 pips below and target 40 pips higher, okay? And indeed, even in my 1 hour chart, the ADX is around 20. So it means that trend is weakening, but I need to wait and see. I need to wait to see whether my asset will break by at least 15 pips the previous day's low, or whether it will turn up and break by around 15 pips the previous day's highs in order to decide whether I will enter long or whether I will enter short. Is that clear now? Hopefully it does. In regards to the European Open, by the way, and the Frankfurt Open and European Open, let's see whether we can find an example. So here is the European Open and the Frankfurt Open. Here is the Frankfurt Open. So that's the high of Frankfurt. That's the low. That's the high. That's done. Okay. So this is, okay, I will zoom in just to try to find another example for you guys. Go to the 15-minute chart, get backwards. Okay. Ignore this line. That's the Frankfurt Open and the UK Open. Let me get rid of that as well. So here is am I right? Wait a minute. So that's the high of the Frankfurt Open, and that's the low of the Let me just check. $8 o'clock. Okay, that's the Frankfurt. That's the London Open. So the high of between. So here is. Okay, here it is the region between the London Open and the Frankfurt Open. So I have put a line on the range low in this hour. I put a line over here on the latest low, and I have seen that it gapped up. It on the open of the London Open, it jumped up to here, and then continue consolidating. Eventually, however, it broke my range low, and that is suggesting, let's get back to our strategy. The asset needs, in order to apply the waiting for the deal. Come on, they're waiting for the deal. Waiting for the deal strategy. We need to see the asset trading more than 25 pips above the high of the Frankfurt Empower time, or yes, around. So it needs to go up first and then down. But in this case, we can see that it didn't move 25 pips above the London and Frankfurt Open. So it never did. Instead, it quickly turned down. So we cannot apply the waiting for the deal. So okay, we did our homework, but it didn't trigger an entry. So we are just ignore it. Okay. I need to find. So let's see another example. That's cable 15 minutes chart. So this morning, let's see this morning. Let's find out the Frankfurt and London Open. So where is it? It's here. And the London Open is, oh, here. We had a lot of volatility this morning anyway, so. And let me zoom out a bit. So the high of this range, the low of this range is down here. And the high of this range is here. And as we said, we need to see the asset to trade more than 25 pips above or below the this power hour. Okay, let's see what happened. Oops, sorry. So after the London Open, it continued turning down, down, down. Did it post at 25 pips? Yes, more than 25, actually nearly double. So, okay, it did. So we need to wait. Indeed, it is traded 25 pips since more than 25 pips away from the London Open, but downwards. So it dipped down to 130.2370. So what's the second requirement? The second requirement, remember, after we see whether it trades 25 pips above the high or 25 pips above the open price or below, we need to see whether it will reverse and penetrate, right? So let's see. In this case, come on, it was shifted down and then it started reversing and penetrating away from the new low. Okay, so that is triggering a potential So it reverses and penetrates the low of the, can you see that? It turned down and then it revert and retest the range low that we have seen during the London and Frankfurt session. So it reverts and retest this low. So that could trigger a short position again. Okay, short position again. However, 25 pips below, sorry, 10 pips below the low of the range. That one will mean around here. Yes, somewhere here. Okay, entry over here with the protective stop loss no more than 25 pips away from the entry. Okay, then 25 pips, that will mean somewhere here. Okay. Sorry. Sorry. Oh, I need the MT4, not the slideshow. So, come on, I will shift it to be around 25 pips. Come on. Around 25 pips away from the entry, and it should be double of what we had. So, okay, no, it doesn't satisfy our requirements. High, low, then it turned down. It extended further from the new range low by more than 25 pips, but below the range low, not above the range low. So yes, no, the conditions are not being met. And if the conditions are not being met, then don't take the entry, guys, okay? Don't take the entry. It's difficult to find an example, a live example right now, but don't try to just force it and find and apply the strategy. If the asset doesn't do the steps of the strategy, then don't apply it. Okay, this is it. Let me check. Frankfurt. So Frankfurt opened somewhere. They would open here. London open here. It moved below. So still, again, neither euro dollar satisfies the waiting for the deal strategy right now. They might do on the European Open Pan, who knows? We need to wait because you see they are consolidating. So there is nothing really right now. They are just consolidating. So they are still below the Frankfurt, that Frankfurt London range low. So for the time being, they don't satisfy the second step, which is penetrate, reverse and penetrate. Okay, so that's why I cannot apply it. Sorry, I couldn't find a live example right now, Akorede. So I will call it a date. Okay, it's already we are already nearly 2 hours live, so I'm a bit tired. If you want further help, text me, send me an email at webinars@hfm.com, maybe taking a screenshot like these ones, like the ones that I have taken from my MT4, and ask me anything you want. I will try to help, okay? So I will call it a day. Thank you very much for attending. Have a great day ahead and see you again later. Bye-bye.